Good morning. Welcome to our webinar on the Living Portfolio, a logical approach to containing your investment risk. I'm Scott Bussey with Baring Financial Advisors. I want to welcome you to our webinar today. This is my information as well as contact information in my background. We're going to cover a couple of the preliminaries first before we get started. Let me say that Baring Financial Advisors does offer securities and investment advisory advice through our registered investment advisor, VSR Financial Services, who is an RIA and member of FINRA and SIPC. Baring Financial is not owned or controlled by VSR Financial Services. Some housekeeping items about the technology here and the hookup that we have. If you experience an interruption in the transmission of this webinar, click on the lower right-hand corner, exiting full screen on the lower right-hand corner, then go up to the URL web address window and click on the refresh button. That's the circle with the arrow on it. This is intended to be about a 30-minute presentation, net of this introduction. So we will handle questions or comments that you might have individually, separate and apart from this presentation, either by phone, email, Twitter, etc. If you receive a very short survey request from Laura Donahue after this presentation, please know that we greatly appreciate your responses to our survey. We plan to continue to educate our clients, financial advisors, and investing public, so your survey comments will definitely help us deliver the most useful content. Can I give you a little bit of information about Baring Financial? Excuse me for that. Baring Financial was founded in 2002, serving institutional as well as retail or private clients. We were a classic financial planning model, but we also offered contract due diligence for our financial institution clients. We got into tactical money management, and now we are a private client-only company servicing individual investors, and we pursue the study of investment risk and management of that since the mid-2000s, early 2000s. Today we specialize in factor-driven, stock-based investment models, managing tactically investing in those different asset classes such as alternatives, international equities, U.S. equities, commodities, currencies, fixed income, and we are specialists in investment risk management. I want to begin with a story from the book Why Smart People Make Big Money Mistakes, written by Gary Belsky and Thomas Gilovich. By the third day of their honeymoon in Las Vegas, the newlyweds had lost their $1,000 gambling allowance. That night in bed, the groom noticed a glowing object on the dresser. Upon closer inspection, he realized it was a $5 chip they'd saved as a souvenir. Strangely, the number 17 was flashing on the chip's face. Taking this as an omen, he donned his green bathrobe and rushed down to the roulette tables, where he placed the $5 chip on the square marked 17. Surely enough, the ball hit 17, and the 35-to-1 bet paid $175. He let his winnings ride, and once again the little ball landed on 17, paying $6,125. And so it went until the lucky groom was about to wager $7.5 million. Unfortunately, the floor manager intervened, claiming that the casino didn't have the money to pay should 17 hit again. Undaunted, the groom taxied to a Better Finance casino downtown. Once again, he bet it all on 17, and once again it hit, paying more than $262 million. Ecstatic, he let his millions ride, only to lose it all when the ball fell on 18. Broke and dejected, the groom walked the several miles back to his hotel. "Where were you, honey?" asked his bride as he entered their room. "Oh, playing roulette." "How'd you do?" Not bad. Lost $5. This story, now legend, of the man in the green bathrobe is known by casino pit bosses but now also renowned by behavioral economists because it deals with the bedrock principle called mental accounting. Because our newlywed started this evening with just $5, he felt his loss was limited to just that amount. This illusion of playing with the house's money plays as much a part in why casinos make so much money as the odds that favor them to begin with. Other illusions that innately work against the individual come from our cognitive biases as a result of the wiring, the neurology of our brains, and the predispositions we have to over or underreact to things like investing in the stock market, according to studies in the field of behavioral economics. Here are some examples: asymmetrical responses to losing trades and winning trades. In other words, losing trades evoke twice the emotional intensity as winning trades. The disposition effect, where investors sell winning stocks far too soon and hold losing stocks far too long. Decision paralysis, and countless more behavioral rooted inclinations that affect and impede our ability to remain rational about our own investment portfolios. Now, the Living Portfolio is the title to our presentation, and you might be thinking that's an odd title for a webinar on investing. But let me tell you this, my hope for you is that by the end of this presentation, you'll come to appreciate that, similar to anything else we rely on for sustenance, like a home, food, job, personal relationships, we need to commit time, attention, and caring to our investments if they're to fulfill our expectations for them. Neglecting them has consequences. So too do emotion-based decisions when it comes to investing. A logical system can help you. And the goal of this presentation is to equip you with the awareness and the know-how you need to begin using a system tomorrow that will help you address risk and invest more confidently today. We'll begin to explore the logic of our systems-based approach by talking about things like investment risk. How is it managed? What is investment risk? Who's going to manage it? Why even use risk management? And how to use a system like the DREAM system. Let's next explore investment risk. We'll examine investment risk and answer these questions. What is investment risk? How does it threaten the outcome? How can we address investment risk? Should we grin and bear it? That's called the buy and hold strategy. Should we avoid it? Remember, no risk, no return. Should we insure it? Now that comes with its costs, comes with some limitations. How about be adaptable to it? Does that sound interesting enough to you? Let's see how our industry defines investment risk. FINRA describes investment risk to be synonymous with systematic risk, and they term that the risk from events that cause all stock prices to fall. And FINRA goes on to say that diversification, at least among risk-on or growth-oriented asset classes alone, does not work. The only real defense, including certificates of deposit and fixed yield, fixed maturity assets like fixed income or bond type securities. Now, after 6,000 more words circumnavigating the subject of investment risk, FINRA finally admits that modern portfolio theory, also known as the buy and hold strategy, is the industry standard for dealing with investment risk. So here's my question to you. Does a one-size-fits-all approach seem like the right way to deal with each and every single client's unique makeup? Now, there's a variety of risk categories that will affect client portfolios. Here, I'm going to list some that are quantifiable, while others are going to play themselves out in more uncertain ways. There's cognitive biases, which we referred to at the opening of this webinar. This is based on the baggage or the heuristics we rely on. In other words, these heuristics or rules of thumb shape our expectations or hopes for a favorable outcome, or conversely, the fear of an unfavorable outcome. Making decisions based on our cognitive biases can get us into trouble. Inflation risk. Now, this is posed by the assets or a portfolio that can't keep pace with inflation, simply can't grow at a rate equal to or greater than the rate of inflation, currently 2.5, 2.6%, hopefully. Here's an example. Those certificates of deposit and bonds that FINRA suggests that you own in your portfolio, 10-year Treasury bond notes today are yielding 2.5%. With inflation running at 2.5 to 2.6%, we are on the cusp of experiencing a negative real return. That is a return after inflation of zero or negative numbers. The next risk is timing risk, also known as point-in-time risk or sequence of return risk. Timing risk focuses on the likelihood of negative events occurring at the wrong time. Things like retirement occurring just prior to a cyclical market downturn, or a black swan event occurring, such as the 2007-2008 financial crisis. Now, a black swan event is an event that whose outcome deviates far beyond what's normally expected. In fact, it's so anomalous that it changes our perception of reality as a whole, which leads us to the next kind of risk, which is situational decisioning. It deals with how we change our tolerance or our outlook, thus our decisions based on prior year's performance on how we're going to invest from that point on. Not always a very reliable source. Fear is not a good indicator. Portfolio failure risk occurs where investment performance is insufficient to keep up with a retiree's portfolio and keep it from depleting its asset base because the retiree's withdrawals continue to be made at preset amounts without adjusting downward for the subpar investment performance over that term. That's also portfolio failure risk has another name referred to as excess withdrawal risk. So we've identified a few forms of investment risk. The next thing we'll do is talk about how to put a plan together to manage that risk. Let's start with the definition of risk and how we manage that risk, called risk management. Risk management is described as the identification, analysis, and acceptance or mitigation of uncertainty in investment decision making. We identify and analyze the uncertainty, and we decide to either mitigate that uncertainty or accept it, take it on in just making our investments today. So we'll take those two steps, the identification and analysis, and then we'll consider whether or not we'll accept or mitigate that uncertainty or that risk we call investment risk. And finally, by the end of the presentation, you'll be able to put your own brand of investment risk to work for you and your investments. The next slide gives us a sense of why we want to give some credibility to investment risk. And this deals with sequence of returns. Sequence of returns risk indicates that if the timing of returns, if we were to begin our retirement early on, let's say on January 1st of 2001, and experience a 20% downturn, we would need a 25% rate of return just to get back to where we were before that 20% downdraft. If the account drops by 25%, we would need to return a positive over 33% on our portfolio just to get back to where we were prior to that drawdown. The next piece I'd like to point out is exactly shows us from a historical perspective how bad it can get. This is a research report provided by Ned Davis Research, which covers a period of time spanning over 84 years from 1928 to 2012. It categorizes the market corrections, and that is to say drawdowns, by 5% or more, 10% or more, 15 or 20% or more. We'll focus on the far right two columns here. It occurred 43 times over that 84 and a third year span, averaging one occurrence every other year, lasting a little over 6 months and 10 days, and having a mean decline percentage of over 28%. Corrections greater than 20% occurred every third year, lasting 30 months long, with a mean decline percentage of 36%. Now this gives us a sense of how frequently we can expect these negative performance periods. So let's go back to that January 1, 2001 scenario and assume that Mr. and Mrs. Jones have decided to start their retirement years on January 1 of 2001. Sitting with their financial advisors, they all agree that a 7% rate of return, compounded annually, would be a reasonable expectation of return for at least the equity portion of that portfolio. Well, let's turn the page to see how that portfolio actually performed. Good news and bad news here. First, the good news. 7 out of the 10 of those years out of the first decade were up years, and 3 out of those 10 years were down years. However, due to the timing and the severity of those negative return years, we see that this portfolio performed far less than the 7% annual amount we expected. In fact, instead of growing to $196,700, which is what it would have grown to at 7% annual compounded, it only grew to $116,700, averaging 1.6%, or an annual compounded rate of return of 1.55%. Adding injury to insult, we would have made a return of greater than this if we had been invested in sheer money market mutual funds. The portfolio would have grown to a value of $123,000. There's not a lot of life in a portfolio that languishes like this over a period of 10 years. These aren't 10 consecutive years of the same rates of performance. However, the timing and the severity of the negative performance did have a significant drain and an effect on the outcome of this portfolio during its first decade of servicing the client's cost of living during their first decade of retirement. So could we come up with a plan to avoid this from happening? Is there a way we could help this portfolio sustain itself in a healthier, more vibrant life? Do we choose to accept this risk, or should we try to mitigate that risk? Do you have a contingency plan for when things break down? Seriously, how should we approach building a plan to manage investment risk? Let's begin by establishing a few absolutes as guiding principles to managing investment risk. First, proactive management is better than reactive. It's better to have a plan and not need it than to not have a plan and need one. That's a good place to start. The second one is the responsibility for managing risk is not limited to the investment manager. No, the owner of that portfolio, the investor, him or herself, needs to provide input and guidance as to what their expectations are. If the financial advisor or the investment manager is working with another third party as a sub-advisor or a third party separately managed account manager, they need to convey what the client's expectations are as well and remain attuned to what that portfolio, how that portfolio is being managed in adverse as well as favorable market conditions. And the third one, if you cannot assess the risk of an investment, you probably shouldn't own it, or else admit to yourself that you're a speculator, not an investor, as relates to that particular asset class. And finally, at least at Bearing Financial, we believe that risk management framework should be aligned to client objectives, expectations, and our investment horizons. That is to say, they should reflect each client's individual circumstances. So we build our framework on a proactive, quantifiable, systematic process. We call that process the DREAM system, a dynamic risk evaluation and allocation management system. Here's how it works. Our model downloads market data nightly. More than 36 market data elements fed into 9 key indicators, 3 long-term indicators, 3 medium-term indicators, and 3 short-term indicators. Based on that updated data, the 9 key DREAM indicators are coded according to risk classification. Based on these classifications, the model will then prescribe to us any one of 4 settings that will cap the level of equity investments we hold for our clients based on their predetermined equity limits. In other words, these DREAM settings will be 100%, 75%, 50%, and 25% of the client's specific equity maximum exposure. For the sake of today's discussion, let's focus on one of the DREAM indicators. We call out, in this case, the bullish percent. And this refers to the percentage of stocks within a given universe that are on buy signals. For example, if 450 S&P 500 stocks are trading on buy signals, then the bullish percent for S&P 500 stocks is 90%. Bullish percent is used for measuring risk, and we also use it to observe the competing forces of supply versus demand for stocks. So let's take a look at a trend chart for the bullish percent for New York Stock Exchange stocks, numbering over 2,500 stocks currently, to see how this trend chart will track bullish percents. Here we have a chart, it's a point and figure chart that shows hash marks showing vertically the periods of time indicating the beginnings of new years. The left-hand scale is the percentage of stocks on buy signals. There are 3, we see X columns showing movement upward and O columns showing movement downward. The numbers indicate the months of the year, 1 through 9, January through September, A, B, C, October through December. We see here in February of 2007, that 74% of the stocks in the New York Stock Exchange were giving buy signals. Again, in April of 2007, 74% giving buy signals. We saw that amount drop. We saw the percentage giving buy signals drop to a low of 30%, and in here we started to see some, at least a signal for a really, really bumpy time. And by October of 2007, we hit a lower high, a lower peak than the prior X. It moved back down. Through the O column. We see it printed an even lower low at the beginning of 2008. If we were to look at no other indicator than the bullish percent, this particular chart would have indicated to us that we were in for some rough sledding, to say the least. this would show where we might have wanted to exit some of our stock positions. In October of 2008, we saw just 4% of the stocks giving buy signals, and that was a deep trough that we saw with 96% of the stocks giving sell signals. And in November, we saw that increase to 8%, and in March of 2009, we saw it increase to 14%. So in October 2007, the S&P 500, or the stock market, was at 1562. It dropped in October 2008 to 840. That was a 46% drop in the marketplace. We saw a higher high here. We actually got a little optimistic on this and saw a higher print, yet the stock market was still, in terms of its overall valuation, was dropping by a total of 56%. So while the bullish percent dropped and turned back up, the headlines were telling most investors to get out, while the dream system was telling us to begin to put money into equities. The question here is, are you going to invest according to the headlines? Will you be trading out of equities at a time when perhaps you might be needing to go back in? It's hard not to be emotional about investing, but to be otherwise is to be an outlier. Will you set yourself apart by using a logical system to address risk and keep your investment portfolio viable and alive? Our plan is to use the dream system. It's not perfect, no system is, but when the dream system isn't right, it'll correct itself to get us back on the path. It's not a market timing element, it's not predictive, it's trend following. And it measures the risk levels in the equity markets and recommends the corresponding limit on exposure to that risk. It's not based on emotion, it's based on evidence. Now, I promised you that you'd be ready to put the dream system to use in your portfolio or your book of business if you're a financial advisor before we wind this up. So let's see how that might work. We have here just a grid which is designed to get us thinking systematically about risk management. What we have here are the 4 different levels of the dream system. Bull cycle, 100% offense. Bull watch, 75, 50, and 25%. TMA stacks here indicate tactically managed account 5 investors to tactically managed account 10 investors. A TMA 5 client would be a client who would be capped at 50% equities under the best of circumstances, and a TMA 10 client would own as much as 100% equities when things are optimal. However, the dream system will indicate when we should be at full or a bull cycle offense, a bull watch, bear watch levels, and bear cycles. So, for example, a 70% equity investor might be at 70%, might be at 52.5%, might be at 35%, or 17.5%, depending on the symbols or the indicators in the marketplace. So we follow 5 basic steps, and you might want to follow at least 3 of these 5 when we start dealing with our portfolios. The first is to determine by risk tolerance what the maximum TMA code would be. We'd establish that maximum risk level and apply that client's portfolio accordingly. Third step is addressing risk management. Is it going to be used or is it not? That's maybe just as simple as a check of the box, yes or no. The fourth step we take is to manage the equity levels ongoing according to the dream updates, which can be tracked on Twitter or on the home page of Baring Financial's website. The fifth step, again optional in most cases, is that we tactically manage the accounts to stay in the strong relative strength asset classes and avoid the weak ones. Now, this is intended for you to envision how you might manage your book of business, as I said before, or segments of your book of business. The idea here is to just get you thinking systematically. Now, if you're not thinking about it right now, let me go ahead and indicate to you right now. In 2014, we've had 4 changes thus far. We're currently at 100% offense. In 2013, we just had 1 change in the Dream System level. That occurred in the 2nd week of January, and we remained at 100% offense for the balance of the year. Yes, it was a very good year. 2012, however, was an extremely choppy year, and we experienced 13 different level changes during that year. So how can you possibly use the Dream System? You can incorporate it in your client investment policy questionnaire and policy statement. Do you want to have risk management applied to your portfolio? Yes or no? We use it also to allocate, rebalance 401ks on a periodic basis. We also, on a seasonal basis, use it to influence our annuity sub-account allocation and rebalancing, especially for those accounts that don't have guaranteed living benefits. It pops up in a new client acquisition conversation when clients ask that inevitable question, what will you do when the market craters? The answer to that is the simple, we have a Dream System. It systematically measures the changing levels of risk in the marketplace, and it prescribes the limits to which we'll be exposed to it. Clients' eyebrows raise at that, knowing full well that we have a plan and we're going to protect their accounts. They feel much, much better about hiring us as their investment manager. We use the Dream System as a reference point when we are adding new investment dollars to existing brokerage accounts. And we've applied the Dream System systematically across a couple of different brokerage platforms that has really helped us from a logistical standpoint in implementing the Dream System on a timely basis. There are many, many more ways that you can use the Dream System as either your second opinion or your third base coach, whether you want to round third and head on home, just amp up your portfolios to their full client suitable level of exposure, or whether you need to throttle it back. I want to tell you that since 2007 we've adopted the mission to save our clients, friends, family from financial ruin by keeping their investment portfolios alive and thriving. If you have any questions about how the Dream System can help you, I am happy to discuss our experiences and our approach with you directly. You can contact us for a free consultation. We're happy to talk to you over the telephone. You can check us out on our website address. Follow me or the Dream System. We're both on Twitter. I want to tell you that I appreciate you participating in this webinar today. Some of the biggest names on Wall Street are predicting major corrections when the Fed intervention ends. My question is, do you think you need to know what will happen when the Fed stops its quantitative easing? The short answer is no. We don't need to know what will happen. We just need to have a guidance system showing us how to respond to the next sea change, whether it's the end of QE or any other market-moving event. I can coach you towards investing prudently. I can help you keep your investments alive. Again, thank you for participating. Don't fear the market. Have an awesome day.